All right, to talk more about what transpired at Jackson Hole, we're now joined by Gaurav Sen Gupta and the Chief Economist, IDFC First Bank, and we're also joined by Sunil Subramaniam, market expert, joining us. Hi, good afternoon to both of you. Thank you so much for taking the time out and joining us, Gaurav and Sunil. Thank you so much for joining us. Sunil, let me come to you for the first comments. The dovish stance coming in there. Fed chair seeing more risks as far as the labor market is concerned instead of now the inflation. So there is a clear shift in the stance. What do you make of the first comments, and what would be your take? What is your reading into what Jerome Powell had said?
So I think that basically he's responding to data. So first, it's not a change in his thought process vis-a-vis succumbing to thumb pressure or anything like that. No, I think he's very clearly focused on the data. But I think what was interesting was what conclusion he's drawing from the data. So I would point to three things. So first is he's talking about the labor market risks. So which means that now he's recognizing that in India, it's always inflation versus growth. In the US, it's always inflation versus the labor market. So I think what he's seeing is that the first signs of distress in the labor market. So I think that's an acknowledgement. So it's a big shift from the earlier where he was talking about the peak employment status, that was actually supporting his view of not having rate cuts. The second thing is that he acknowledged that inflation was rising with a tariff, but he's very careful to say that it'll be a one-time. One-time, he does not mean all at one time, but he said spread over. But what he says is that one side, the inflation resets at a slightly higher level, after which it will be stable. So I think these two are very significant, that he's not worried about a prolonged rise in inflation, but he's worried about a prolonged labor market weakness. So these two, I think, combined together is what the market participants are reading as he's saying that a September rate cut is on the cards. Now, he didn't spell it out in those words so much, but I think the market is used to. And coming from the days of Bernanke and Greenspan, where even the raising of an eyebrow was treated by the market as a signal, I think today you have words from him. And the market, naturally, the Dow and the Nasdaq are up almost 1.9%. S&P is up 1.5%. The dollar has weakened 0.8%. And the Treasury yields have also come off by about 6-7 basis points. So clearly, market has judged this whole thing as saying there is a change in his stance. And while short of prescribing a rate cut in September, I think if this same trend continues, we are likely to see a rate cut in September. So I think overall, just to sum it up, I think that the data has made Powell soften his stance on the rates issue.
Right. Gaurav, let me come to you. Do you concur with Sunil that perhaps, of course, it was a dovish stance, but, the point of not looking at inflation, do you think we are really throwing caution to the wind? Because, historically also, whenever there have been any increases in the tariffs, those costs get passed down to the consumers, and therefore it will give rise to a higher inflation. Are we not pricing that in?
Thank you so much. So I think what the Fed chair was trying to say that they do expect inflation to pick up. In fact, if you look at the core inflation in the US, there is a decisive pickup that we are seeing on goods inflation, but which has gone to around 1%. And this is a change in trend. Earlier, goods inflation in the US was actually easing. But for now, what we are seeing is only 10% of the increase in tariff has actually showed up in the goods inflation. So you will see more and more of it transmitted by companies as the months progress. So he has acknowledged that, but I think the change in his assessment from what I see in his comments at Jackson Hole versus his comments in the previous Fed policy is that earlier they were unsure whether the pickup in inflation would be a one time or whether it could lead to a sort of a persistent sort of spiral. But here he seemed more confident that it would lead to a one-time pickup. So they will look through the pickup in inflation because he sees very low risk of a wage price spiral developing, because as he mentioned that the slack in the labor market in the US has increased with the latest job sprint. The number of employment created per month has been far softer than expected. Moreover, the 2 months before data has been revised down. So the fact that employment in the US has stayed near historical lows, it's more to do with the fact that while there is also a reduction in supply, demand for labor has also come down. So that is artificially keeping the employment rate low. So it's an employment rate which is being kept low by negative factors, the reduction in demand for labor, rather than uh, rather than positive factors. For example, if the supply of labor had picked up, that would have been a positive factor for keeping unemployment rate low. But this particular unemployment rate is driven by demand for labor staying weak. So it's a negative factor. So he sees that there is slack in the economy. So he does not see the risk of a wage price spiral developing because of the tariffs. So in his assessment, at least what he's spoken at his latest, at this Jackson Hole meeting, he sees it's a one-time pickup, and the Fed will tend to look through it and focus more on the growth bit, which they look via the labor market. And he also mentioned that the policy setting is restrictive and requires adjustment. So he's clearly indicating a downward shift in rates, which could come as quickly as maybe the September policy.
Right. Sunil, let me come to you. We had global guests in the morning and we were discussing about this, and they said that you also mentioned how the US markets are setting at record highs, and there was such strong moves coming in on Wall Street after this. They said that perhaps markets are overreacting. We are not, there are a lot of, they're throwing caution to the wind. Is the risk on sentiment back, and do you think this is over exuberance that we witness on Wall Street?
Not at all. I think the markets react to expectations of movements. And since the Trump-Powell standoff had occupied so much mind share, I think that any softening from Powell, I think they are seeing that, May 26, his term anyway ends. Already Mr. Trump is populating the Fed boards with his nominees. So clearly, decisively, the thing is shifting in favor of a softer interest rate stance. And I think the market is reading into that Powell is not taking a last kind of a stand that before I go, I will still not cut. He is softening. So I think the market reads these signals very well. So the question of over-exuberance is because from a people's perspective, right, the US stock market has been of interest for a very long time. So I think that the shift of flows, you know that the US accounts only for 30% of the world GDP, but is more than 60% of the world stock market. So I think that clearly risk on is on to your question, that they're willing to take risk. And I expect that naturally some of this will now spill over into an emerging market taking risk on also. So I think that I don't think the market is overreacting. This is because the fact that there had been uncertainty is going away, that is getting releasing the pressure and the market is getting support. So to that answer, I don't think this is over exuberance, but definitely to the extent that some markets haven't got risk capital, this will now reallocate that towards more riskier emerging markets also, I feel.
I'm coming to you for that question. In fact, I'll take a leaf from that. The emerging markets now, clearly, if the interest rates cut comes through, we will see the bond yields come off, the dollar index cooling. That augurs very well for emerging markets as well, and the allocation to emerging markets. Where does India stand in that case? Of course, we are seeing that Trump trade-off with India that's going on. Where does India stand in the larger scheme of things as far as the emerging markets are concerned then?
So I think there are two ways to look at it. Compared with the recent history of flows into India, there will be a pickup because the overall pool for the emerging markets will go up and India will get a share. But India's problem has not been that alone. It's also been that whatever the pool is, China, Hong Kong, South Korea have been getting far greater allocations because they represent a better value package. Because Indian markets growth is already in the price, and because domestic buying has been strong, the markets haven't fallen in response to FII volatility. So the markets have remained fairly stable, so they're not cheap by any standards. So while more money will come to the emerging markets and India will get a share, it may not be as much as it would have been if the Indian markets had corrected a bit. So I would still expect that China and South Korea will get a lion's share of this fresh money, but India will also get a share, and which hopefully will tilt the balance from a net negative FII flow situation in India to a positive FII flow. But it can go up really sharper if India's growth perspectives come through strongly, like the flow through of the GST. Those numbers, they come in and show a very good growth rate, as well as the S&P 500 Joby upgrading will involve some amount of risk reevaluation of India, which could lead to a little bit of extra flows. So India will get its share, but I think we can get much more if our growth comes through and demonstrates strength.
Sunil, let me come to you, Gaura, in that case, and let me take some points from there. Come second half of this year, we will see some results playing out, if you will, whether it is the GST rate rationalization, whether it is perhaps a better earnings growth. Also, the fact that we have had interest rate cuts, we also have, the government, which is absolutely positive on, increasing consumption in the economy, and that's where the focus is. There is liquidity in the market, and now with the US cutting interest rates, and of course the FII flows, like Sunil mentioned, could perhaps turn positive on India. Do you see better days ahead as far as Indian markets are concerned in the second half of this year?
Depends which market you are referring to. So each market has a different dynamic. So as I'm an economist, I can give you a much better flavor of, let's say, the currency and the fixed income market. In the case of the currency market, I definitely, with the US, especially the Fed chair, he's gone from sounding much less comfortable on where the policy is to indicating that they need to adjust it downwards, or you could see a shallow, maybe 1 to 2 more rate cuts coming in. If you look at the fixed income markets in the US, they have already priced in around 2 rate cuts. So it could start as soon as maybe September. We could see some, in the case of, from that, it'll translate into, let's say, less depreciation pressure on the INR. The INR has stabilized around between 87, 87.50 levels. The pressure on the currency has been not just a story of the risk of sentiment that got triggered on emerging markets as a whole, but it's also a story of capital flows. Capital flows to emerging markets have been weaker. There's also an issue of the fact that the RBI forward book, which consists of a large buildup of net dollar short positions, that has to be unwound. So the combination of flows, if let's say there is a substantial pickup in capital inflows into the emerging markets, then yes, we have a sort of a change in trend in terms of the currency. But if you assume, let's say, the US cuts interest rates by 2 more times in this year, and the Fed currently is allowing its balance sheet to shrink, but at a much more moderate pace, it's likely that after some time they'll hold their balance sheet unchanged. If that sort of scenario plays out, I don't think flows into emerging markets they will improve a bit, but they won't change materially. So that, in conjunction with the fact that we have that large negative forward book, we still see the currency holding around 87.50 levels in the near term. And there's also that tariff tension which is playing out. Our base case is that the ultimate tariffs between US and India should not be close to 50. Maybe we get somewhere around the 25% handle. It's still relatively negative to what the tariff rates are for the other Asian countries, but it'll be a lower negative than a 50% tariff, which is hopefully we are able to avoid. Apart from that, the bond market for India, definitely some easing of the yields in the US will be some good news for the bond market, much needed good news for our bond market. But the rally in our bond market will be a function of our domestic factors. For example, how the bond supply pans out in the second half, and also will be a function of our own rate cut cycle. So in the case of India, RBI, will be domestic factors which will play out, which will put precedent. But yes, if let's say the US Fed gives us 2 more rate cuts, it gives the degree of freedom to RBI, increases the degrees of freedom for RBI, because the interest rate differentials between US and India have narrowed to historical lows. So it will also, I would say, the interim help some moderation in the yields in the Indian markets, but the sustainability of that rally will depend on domestic factors. How our own central bank, for example, right now the indication from our own central bank, the RBI, is that they are quite comfortable with the status quo position, because of the fact that for now, at least in India, growth is stable. And so they want to see the impact of the past rate cuts play out. So for us, yes, in the interim, this is good news. You can see some reduction in Indian bond yields, but for that to sustain, you will also need, let's say, RBI giving indication that going forward we may have some rate cuts in the offing. Also, there is a supply issue of government bonds in the second half of the year. That also we'll have to see how the market reacts to that. So, but yes, at the margin, this will help reduce the depreciation pressure on the INR. It will also give some relief to the Indian bond markets.
To Indian bond yields and also reduce the pressure on the depreciation of rupee. Sunil, let me come to you. What are your thoughts? I know if you had a crystal perhaps in the second half, what do you see for Indian markets? As far as the domestically, if you see, the conditions are quite ripe. I mean, of course, there are certain headwinds that Gaura just mentioned, but otherwise, there is a big boost coming in terms of consumption, in terms of liquidity, in terms of the fact that, of course, if the rate cuts come through, we also have, that might be positive for inflows into Indian market as well. What will you pencil in for Indian markets, therefore?
I see that the festival season is crucial because I think between the government and the RBI, they've done everything they can to support the sentiment of the consumer to consume. See, this 1 lakh crore giveaway in the budget, right? People have tended to save it more than spend. That's very clear from the consumption data coming through. So there's a mindset issue of the customer on wanting to spend. Now, to support that is where you had RBI do a 100 basis point rate cut, liquidity inflows and everything. And now with the GST also coming through, hopefully that's the tilting point. And the government is very clear that with an early Diwali, they're pushing the GST Council to quickly take a decision in September. And my understanding is they may even make the effective date 1st September, though the actual decision will come through in the month of September. So all of this would mean that a lot of the piled up inventory at the dealers, right? Because initially there might be a postponement of purchase because people will say if the GST is going to get cut, why buy now? Let me buy closer to when it's actually in place. So for a month or two, you might see that the dealer points may stock up, but the sales may not go through. But with the festival season being early, and if there's a massive pickup in that, I think that's be the trigger for the FIIs also to say, yes, the government's actions are ring and the growth can go up and justify the valuations. So our situation is never going to be that we'll become cheaper and then FIIs can come in. It has to be that the growth steps up and justifies the valuation. So I think the monsoon has come through very good so far. That's good news. The festival season sales should come through. So from that point of view, I think the markets can very well end at a new high by the end of the year. Because remember, with October 23rd being Diwali, the impact of that will be seen only in the January results season. So I think by the end of the year, you will be able to see all of this flow through, and keeping the fingers crossed that the FII flows again step up, market could see new highs by the end of the year. I'm very optimistic on that scenario.
That's a very optimistic scenario. And still, I do agree with the fact that perhaps instead of waiting for markets to be priced to perfection, which is unlikely, it is really the growth that has to step up its game in order for the FIIs to come back to India. But, we are getting into festive period. What are the sectors that you're finding value in? Because now we're talking about consumption, because that is where, really the government has given a major fillip. What are the sectors that we need to watch out for come this festive period?
I think that basically automobiles is the key thing, where a small difference in EMI can make me buy that much bigger car, right? Or I was not thinking of a two-wheeler, now it comes into my basket of goods. So I think the two-wheeler segment is, and of course during the monsoon we'll have tractor sales also pick up. So I think clearly automobiles section is the one which will lead the pack. This next section will be consumer durables such as refrigerators, air conditioners, though they are all more in the summer sales. But then if you get good deals, people may say, okay, though it's not hot right now, let me go and buy that because I'm getting a good deal. So the consumer durables pack will be the second one. The third would be the real estate pack, because remember, any effect of the EMI in terms of affordability of the house because of the long 15-20 year tenor of those loans has the biggest impact there. So sentimentally, if the GST cut comes through into cement and building products, and also so the house prices also look to get a little more reasonable, you could see real estate also recover because they're also very rate sensitive in terms of those sectors. But this is more from a near-term perspective. So I would suggest that since the market is immediately reacting to consumption and a lot of the prices have gone up, you mentioned value. To me, a value is there actually in the capital goods segments. And I'll tell you why. Because the problem with India has been the private sector has not been supporting the government with a massive capacity expansions because capacity utilization is hovering at 75, 76, 77%. With the Diwali pickup in this, if the capacity can cross past 80%, they will start doing fresh expansion of capacity, brownfield and greenfield. That means that the cap goods cycle will follow through very shortly. And today that's not yet priced in into the market. So I would say if you have a slightly medium-term perspective to more than 1.5 to 2 years, then I would say capital goods related sector, building material, cement, steel, everything that goes into building something is going to be the place to buy today. And along with that, I would say public sector banks, because when it comes to lending into the capital goods cycle for the medium and small enterprises who will actually do the EPC contractors, who will actually execute the orders, it's the public sector banks which have a good market share there and they know that business well. So I think public sector banks lending book should go up sharply. So with a slightly medium term look, I would say capital goods plus public sector banks would be a good pack where there is, I would say, use the word cautiously to say there is some value in the market.
Banks, cap goods, and perhaps auto to lead the way. Gaura, let me come to you and get in a word about other asset classes, say especially for gold. Now, gold has been a safe haven. We're seeing a lot of global uncertainty in terms of tariffs and so on. But so gold has been doing well over a period of time, and now with the dollar index cooling off, gold prices could also see a sharp uptick. And also the fact that we are getting into the festive period. How do you see the movement on gold?
So definitely there is a linkage between gold and dollars, the lack of dollar strength. So when you have periods of dollar weakness, commodities tend to do better. So gold will get that tailwind of further weakness in the dollar. And the other thing is the kind of uncertainty that we've had since, let's say, the second half of last year, continuing into this year. That's another thing that is, I don't think, going to go away anytime soon. So that sort of safe haven demand for gold is definitely going to hold up. And yes, domestically, festive season coming in should definitely help domestic demand. India is one of the largest consumers of gold. The other thing that will help gold is the fact that rural consumption or rural indicators are beginning to pick up. So if you look at the consumption cycle in India, there are a couple of tailwinds that are coming in, and rural is definitely one of them. If you look at the distribution of the monsoon this year, it's been far better than last year. If you look at rural wage growth, it is now beginning to grow, beat inflation. Last year, rural wage growth was slightly below the inflation, so that's why last year was not so great for rural. But this year, we are seeing signs of a pickup. So look at the FMCG sales volume growth for rural areas. There has been some pickup, maybe even on the tractor sales segment, etc. So whenever rural demand picks up again, that is a good part for gold demand. But yes, gold is one of those rare asset classes that will benefit not just from the dollar strength, it will also it will also benefit from the fact that we are operating in a highly uncertain environment, which is likely to continue. So yes, I don't see any stop to the rally in gold anytime soon.
All right. On that note, we are completely timed out. Gaura and Sunil, thank you so much for taking the time out and joining us. We'll let you go on that note. But with that, it's a wrap on this edition of News Now. I'll take your leave. Thank you so much for tuning in.